Have you ever noticed something strange? The people who seem the calmest during a stock market crash are often the ones who end up building the most wealth. Meanwhile, those who panic, sell everything, and swear they'll never invest again usually miss the biggest opportunities. That raises an important question. What if the biggest risk in investing isn't losing money, but misunderstanding what risk really is? If you're learning how to invest in stocks as a beginner, you've probably been told that the stock market is risky. That's true, but it's only half the story. What almost no one explains is that risk isn't just about prices going down. Real risk is making emotional decisions that keep you from reaching your financial goals. Imagine two friends who each invest the same amount. The first checks the market every day. Every dip feels like a disaster, and every headline makes them second-guess themselves. After a sharp market decline, fear wins, and they sell at a loss. The second friend understands that short-term volatility is normal. They continue investing consistently, ignore the daily noise, and stay focused on the long term. 10 years later, their results are dramatically different. Not because one found better stocks, but because one mastered their emotions. This is where investment psychology becomes more important than stock picking. Legendary investors have long understood that successful investing is less about predicting the future and more about controlling your reactions. The market rewards patience far more often than perfection. Here's another truth that surprises many beginners. Avoiding the stock market completely can be riskier than investing in it. Inflation quietly reduces the purchasing power of your money every year. Cash may feel safe today, but over decades, doing nothing can cost more than temporary market declines. That's why understanding risk versus reward is essential for anyone serious about wealth building and long-term investing. So, how can you become a smarter investor? Start small, invest consistently, diversify instead of chasing hot trends. Accept that markets rise and fall, but remember that temporary declines are a normal part of the journey, not proof that you failed. Focus on building good habits rather than chasing quick profits. If there's one idea I hope you remember, it's this. The greatest risk isn't market volatility, it's letting fear make your financial decisions. Learn to think long-term, stay disciplined, and let time work in your favor. That's how ordinary people build extraordinary wealth, one thoughtful investment at a time.